Hi, I'm Tobias Carlisle. The speech today is on Deep Value, which is a book that came out in 2014. Since then, I've written another one called Concentrated Investing that's out now, and a 2012 book called Quantitative Value, which was written with a Philly local, Wes Gray, whose office I saw for the first time this morning. I've written some other stuff for some textbooks, etc. Spoken at Harvard. Thanks to Michael Bigger, who's here today, Google, CFALA, NISA. The talk today is going to be on deep value and these four broad ideas, what Warren Buffett did in his hedge fund before he was a Berkshire Hathaway chairman and major shareholder, contrarians at the gate, how to beat the little book that beats the market, and simple but not easy. So the strategy that Buffett ran in his hedge fund was quite distinct from the strategy that he runs in Berkshire Hathaway. The returns that he got there were better than he has achieved in Berkshire Hathaway. And I thought it was interesting to just dive into what he was doing to see how it is distinct from the Berkshire Hathaway strategy. So he's remained concentrated. He will size up positions to 40% in the hedge fund, not quite that large in Berkshire, but still very large. And he engaged in deep value. At that time, it was value investing. I call it deep value to distinguish it from the sort of franchise style that he engages in now, which is looking for high quality. The strategy that he engaged in was basically twofold. It was looking for general issues, which was something that was just deeply undervalued, or a workout, which is a special situation, event-driven investing. That's basically where you're looking for a corporate act to resolve the disparity between the underlying value and the price. And the other key thing is that you have some idea about the return. You know how much you'll get back in over a certain period of time. You can determine an annualized rate of return. We do a lot of that in the fund that we manage. But the focus today is the general issues. That made up about 2/3 to 3/4 of Buffett's hedge fund. And there's some interesting things about it that have got lost a little bit recently with how heavily Buffett has promoted his own strategy and the various other attending personalities who've been interested in that strategy. The original conception of deep value or value investing came from a 31-year-old professor, Benjamin Graham. He was quite simply looking for cash on a balance sheet that could be bought for 2/3 or less. And he came up with this iconic sort of description for what he was looking for, which was the 50-cent gold dollar. They're really hard to track down now. There are still some around, and in a sort of 2008, early 2009 scenario, there were quite a few of them around. This is Buffett quoting John Burr Williams, who wrote The Theory of Investment Value. He had a slightly more nuanced definition of value, which was a cash flow definition. Basically, you're looking for a discount rate and a growth rate. And it's very sensitive to those two inputs, your valuation. This is a simple study that we did looking at all of the developed markets around the world, just putting into 5 different buckets, ranking everything on price to book, price to cash flow, price to earnings, putting them into 5 different buckets. Quite clearly, there's very substantial outperformance for the undervalued, which is just cheap on the basis of the fundamentals. And there's quite clearly underperformance on the basis of glamour. Why? Mean reversion. Graham was at a Senate inquiry, and they asked him why. How does it all work? And he gave this sort of great answer that he said, "It's a mystery. It's a mystery to me as it is to everybody else. We don't really know how it works." I think that he was being a little bit coy. We've got a pretty good idea that industries that do very well attract lots of competition, money flows into them until the returns are squeezed away. Industries that have done very badly, people exit, profitability returns. And you can see it in real time with energy recently, and now Amazon is going to eat all of these brick and mortar department stores, so that they've all got very cheap right now. So this is just an interesting analysis of the actual portfolios. This is some classic research by DeBont and Thaler. So they looked at 10 portfolios, one being the most expensive, but on the basis of price to book, 10 being the cheapest on the basis of price to book. And they said, what happens to the underlying fundamentals? So they're looking at earnings per share here. So it's easy to understand why the undervalued portfolio was undervalued. It's because the earnings per share were down 40% over the preceding 3 years. And the overvalued portfolio is overvalued because the earnings are actually up about 40% over that same period. So it's indexed to 100 at the portfolio selection date, so you can see what happens next. Amazingly, if you're looking for earnings growth, the place to find it is in the undervalued portfolio and not in the expensive portfolio. And that's some of that phenomenon that I was discussing before, where the fundamentals of the business change because competition enters or exits the industry. So what if we then went and searched for growth and valuation? So this was 9 portfolios. The entire universe was divided into 3, most expensive, middle, least expensive or undervalued. And then those portfolios were further divided into the rate of growth of the fundamentals. And so I've extracted the 4 that were kind of the edges of that. High growth value is very high growth and undervalued. Glamour is very high growth in fundamentals but expensive, and contrarian value is very low growth or low growth and undervalued. And this is just the statistics for each of those portfolios averaged over the period. So the Glamour grew, so for example, you can see Glamour earnings were growing at 18.7% annually, but you had to pay 19.6 times for those earnings. High growth value had a comparable rate of growth, but they were much cheaper. And then contrarian value, lower growth, a little bit more expensive it seems, but the reason for that is that they were cheap on a price to book basis. Earnings and cash flow were anemic. So Glamour, the portfolios averaged out at about 67.4% over the full period. That's over a rolling 5-year period. High growth value naturally outperforms, and here's the shocker, contrarian value actually does better again. And just to show you that so you can really see it's not a function of the rate of growth, it really is the valuation that makes the difference. Tom Peters wrote this book that is 40 years old as of 2015 called In Search of Excellence. There was nothing really scientific about the way that he selected the companies. He just sort of thought what was cool and what was doing really well. And then he said, what are the financial characteristics of these companies that are excellent? And this is what they are: very rapid asset growth, very rapid equity growth, expensive, but excellent return on capital, return on equity, return on sales. Michelle Clayman, who was an analyst, said, what if we select the other side of that? We'll find the very lowest asset growth, the very lowest equity growth, terrible returns on capital, but we won't pay very much for them. Barry Bannister, who worked with Michelle Clayman, who's now at Stifel, conducted this research, published it in 2013. Over the full period, the unexcellent portfolios massively outperformed the excellent portfolios. There was a brief period through the dot-com mania where that reversed a little bit, but it's typically been the case that unexcellent has outperformed excellent. So there's always a question, is this sort of are you getting some other compensation for buying the high quality portfolios? Do they outperform in bad states of the world, which is just basically growth below the average? And the answer is no. They underperformed through a period that was very good for the world, but they've also got these other periods where they've outperformed through bad periods. There's no rhyme or reason to it, it's largely random. So Buffett, under the influence of Munger, becomes this different style of investor where they're looking for very high returns on invested capital. Joel Greenblatt conducted a study, read through the letters, determined that there were really only two factors that mattered, and then asked this question: is it possible that merely mechanically purchasing these stocks, you can in fact outperform the entire stock market without sort of using Buffett's brilliant analytical mind and without the sustainability? And in our quantitative value book, which came out in 2012, we devolved that strategy down into its two components. So the magic formula really does outperform, even with the, we penalised them for smaller companies. We did a range of things that lagged the data, so there was no question that the test that we was much more rigorous than the one that Greenblatt uses in the book, but there's no question that it genuinely does outperform. So we took the two components of the strategy and devolved them into the two. So one is EBIT on enterprise value. That clearly outperforms just the magic formula. What does return on invested capital do? It underperforms, and it underperforms the market. So if you're selecting for these very high quality companies alone, you underperform. Is that a fluke of these two factors? This is another simple analysis of it. This is a blend starting from 100% return on invested capital. So you select stocks purely, you select a portfolio of 30 stocks purely on those that have the highest return on invested capital. And at this end is selected purely on the basis of enterprise multiple, or acquirers multiple as I like to call it. And magic formula's in the middle there. So there's a clear trend towards valuation. Why? As we were discussing before, it's a function of competition entering and exiting. Michael Mabison has this chart in his book, The Success Equation. He takes 5 buckets of companies that have varying returns on invested capital, and then he tracks the performance of those companies over the following 10 years, and he updates this every year. In every case, the return on invested capital tends to trend towards the median, tends to trend towards the mean. The very best come back a long way, although they don't go all the way back to the pack. But if you're paying up for them, then you need to factor that into the model. And the very worst sort of improve to the point where they are actually profitable over a long period of time. So if you're buying bad quality companies at a big discount, you're getting that rate of growth in earnings, and you're getting an improvement over that period of time. So you get fundamental improvement combined with valuation improvement, which is basically the entire muscle movement for the returns. It's so simple. Why doesn't everybody do it? And the answer is that value underperforms for very long periods of time. This is a 10-year excess return. So it's been tough for sort of 10 or longer years, and it's a lot of underperformance. That's Eddie Elfenbein's quote there that I love. And it happens to everybody. Einhorn had a great period of performance in the early 2000s, hasn't sort of been able to continue on with that, and had a bad year last year. Buffett had the same problem down last year. Everybody knows that Ackman's had a really rough period. And there just really aren't very many undervalued companies around at the moment. They're really difficult to track down. This was a test of the very early stages of quantitative investing, or the very early stages of trying to determine whether a machine could do a better job than a human being. So this is a simple algorithm. Dr. Goldstein managed a hospital, and they had 2 different types of patients. Some would present as very depressed, and some would present as psychotic. And sometimes when they present that way, it's very difficult to tell very depressed people from psychotic people because of they have ideation that makes it difficult to make a distinction. So the psychologists are basically flipping a coin. So he came up with this 8-question test that he handed out to the psychologists, and they were able to apply this to people who came in, and then he collected the answers, went back at the end, looked at who had predicted the best, and he found this sort of distribution of psychologists being able to predict all underperformed the model. So then he handed the model to students and experienced clinicians, and he examined how they performed with the benefit of the model. In this example, they were allowed to waive off so if the model gave them an answer, they were allowed to say, no, the model's wrong, I'm going to apply my own experience. And one thing that stands out, the model definitely improved the performance of each. So where the students had a 59% rate, they went to a 64% rate, but the model continued to outperform. So why? Why is that? The reason is this thing known as the broken leg phenomenon. Let's say you have an idea that John goes to the theatre every Friday, and you factor into it rainfall, the type of movies that are showing, whether it's the end of the month when he gets paid. He has a broken leg. Are you now able to include that into your model? Because surely that's going to affect whether he goes or not. And the answer is you should not. And the reason is that we find more broken legs than there really are. And it's particularly apt if you're a deep value investor, because there are lots of these positions that seem to be the sort of positions that you should kick out. Amazon with the department stores right now is a very good example. Everybody knows that department stores are going to zero. All of a sudden, department stores have had a pretty good run this year. So this is the golden rule. Simple models outperform experts, and they continue to do so even when the experts are able to apply the simple model's output. So my very simple model, which is even simpler than Greenblatt's simple model, is the acquirer's multiple, which is just the EBIT enterprise value portion of his model. This is Rennie Magritte saying this is not a pipe. He's being very clever. This is a picture of a pipe. I use this as an example of we always have to remember that our models are not reality. They are abstractions of reality. And the objective is not necessarily to seek reality through our financial models, but to find something that performs really well. I love Klarman's quote here, because this is the thing that we're always confronted with. The stocks that are likely to outperform the most are the ones that appear most frightening at the time that you go to put them in the portfolio, and everybody else feels the same way, which is why they get so cheap. This is for the guys who like to build the really complicated models. This is a great short story. Basically, the entire nation gave itself over to creating these maps, and the maps became so detailed that they were the size of the entire nation, but no longer useful at that time. Any time that your model goes onto a third tab, that's probably true. And this is, I saw this in relation to the Google self-driving cars. Everybody's sort of terrified of getting behind the wheel. I'm a little bit worried about getting behind the wheel of one of their self-driving cars, but they make this great point that the objective is not perfection. The objective is just better than we drive, and we get distracted. True also in the construction of models and investing. The acquirer's multiple is very simple. It really doesn't matter how you construct it. Operating earnings, EBITDA, EBIT, EBITDA minus CapEx, free cash flow, it all works comparably. Over the full period of the data that we have, it has continued to outperform. But it really doesn't matter. You get the same performance if you take a combination of these factors. You do very well. That's true also internationally. The acquirer's multiple has performed very well in every nation. It remains really unpopular for whatever reason, possibly because there's been a 10-year period of underperformance, but among the factors that people consider, return on invested capital is still much more popular than the value factor. It's worked over the last decade. Even with more and better information, it continues to outperform. Largely that's because it's a behavioural, it's just difficult to buy the companies. Part of being a value investor is just putting up with big declines and underperformance. That's just what happens. So if I can leave you with these 4 ideas, it's simply this: deep value beats high growth and quality. Contrarianism at a fundamental level tends to outperform naive extrapolation, which is an expectation that what you have seen historically in financial statements continues on to the future. Simple models tend to outperform expert discretion, and the acquirer's multiple is the best metric to date. I'd be happy to throw it open to questions. Chuck.
Tobias, you know I'm your biggest fan, so let me ask a challenging question.
This sounds like a bad question.
From the perspective of a fan, let's say we agree with you 1,000%. Let's say we agree that we want to construct a portfolio that consists exclusively of the deepest deep value stocks. And let's say we don't trust human beings for the reasons you said. What about if you separate the universe of deep value stocks into deep value stocks where the corporate governance is set up to entrench the board permanently versus ones where the corporate governance makes it very easy for an activist to replace the board and act as a capitalist? My two questions are, have academics studied whether the corporate governance can dramatically improve the alpha you're talking about? And second of all, if academics have not studied it, and some academics did study it, do you believe it would make a major difference or not in the US and other countries?
They certainly have studied it. Better corporate governance does tend to lead to better returns. And in terms of getting control of a board, they looked at, one of the things that I have looked at, I don't know if I've seen it as a study, but concentration of other investors. You want to be either in the wings, you want to have very little concentration among any investors, which means that it's open for an activist to get control, or you need a good investor who's already got a sizable holding, who you believe, an activist who can actually generate returns. That's a good place to be too. In the middle, there's not really much difference, it's sort of random. Yes, sir.
Not to make you give away your new book, but you're talking concentration. And so whenever you talk totally quant, and you do it in 10 deciles. So do you do further screening?
Yes, yeah. So the quant portfolios tend to be more diversified simply because you can't put 3 or 5% into something that you don't know anything about. I don't think as a fiduciary you can do that. So you need to have a larger portfolio, and then we run we look at fraud statistically, earnings manipulation. We do all these things statistically, financial distress risk, and then we're looking to make sure that the cash earnings are matching the accounting earnings, and we're looking for we're trying to find out how we're being tricked. Why is it so cheap and everybody else knows? If the answer is that some other competitor, if it's a business issue or something like that, then that's the sort of thing that I love, because I know that everybody else hates it. But we have discretionary portfolios as well that are special situations type portfolios, and that's an entirely different process. Yes, sir.
Are you looking like a Greenblatt 20, 30 positions to make it viable?
I think
you go larger?
I think for a PA, that's you don't want to. 20 is enough in a PA. 30 is getting too hard to manage. For scale reasons and other reasons, for business reasons, a lot of the funds, like Greenblatt's fund, tends to have like 1,000 positions in it, long and short. But I think that's a scale issue rather than you can put $1 billion into that, whereas you can't at 20 or 30 positions. They don't trade enough.
And you're still doing a turnover like he does with a 1-year hold on a capital gain and taking the loss prior?
The more rapidly you roll, the better your returns tend to be. And that can go down to about a month, but then you have a tax issue. So for taxable accounts, you need an enormous amount of alpha to get over the tax. I think that Wes Gray, who's my co-author in Quantitative Value, who's based out here, he said that the difference between a taxable account that's rolling for short-term capital gains, the comparable performance to get to sort of 15% in a Buffett style where you're just letting it compound. 15% compounding is worth something like 45% in a short-term taxable account, which is, nobody's doing those returns. Yes, sir.
You know how Greenblatt had his thing where you go to his website and what would you recommend for screening for these things?
Well, I have a website that does that.
It has screening on there?
Yeah, it has screening. It has large cap screening, and for a nominal fee, you can get the small cap stuff. John.
Yeah, Toby, have you ever looked at kind of along the lines of what you were just talking about, but a longer term EV to EBIT?
Do you mean holding for a longer period of time?
For 2
Yeah.
or 3 years.
So one of the nice things about value is it's very robust to that, but you get the biggest performance always comes from that first year because that's the point at which it's stretched the furthest. So it's not true. If you're a quantitative momentum style investor, the more rapidly you roll it, the better you do. But for value guys, you're getting pretty comparable returns at a year, rolling at a year, even out to 5 years. You can keep on selecting and holding. It's just that when the rubber band is really stretched, that's when you get the biggest kind of outperformance, and the returns sort of make that shape. The bulk of the return is in it, but it continues on for 5 years. It's still outperforming 5 years later. Yes, sir.
Do you use momentum as part of your process, and any thoughts on your research around that subject?
I don't. I don't because I'm a value investor. Wes certainly does, and I think Wes keeps them. Wes doesn't mix them in the same account. He has value accounts and he has momentum accounts. Meb Faber has a thing called VAMO, that's exactly what he does. He blends value and momentum. I think you test it and you get returns that are exceptionally good. And then when it's run live, it doesn't really work that well, and I don't know why. It's not something that I would do, but it's a good strategy in backtest.
I'm sorry, what's the downside then from your perspective? Did you say it works until it doesn't?
It works really well in backtest, but it never seems to work. I don't know anybody who's running that. Although the O'Shaughnessy Asset Management, that's their kind of, their flagship, I think, was something like that, trending value, I think they call it. I think that my time is up, folks. I will be up in the function afterwards if you want to come and ask any more questions. I'll answer your question. Yeah, I mean, the best position that I have at the moment is in the discretionary accounts. It's Humana. We might have to do it upstairs.